resale of their vendor partners' products, if the nature of their business relationship with their vendor partners became detrimental, this could pose a threat on their competitive position.
CDW has been growing its net sales by an annual average of 8%, and we expect this trend to continue for 2018. The two main reasons driving this growth are the overall economic conditions in the US and the strong global demand in IT spending. CDW's financial performance is highly correlated to the US economy. US GDP growth is expected to be 2.5% this year. In total, CDW generated over $15 billion in sales in 2017, a record high for the company, with a net profit margin of 3.7%. Profit margin is expected to grow this year, mainly because of their new effective tax rate being lowered, from 36.9% to as low as 24%. This will boost profit margin to 4.3% this year, a 16% improvement from last year. Global demand for IT spending is expected to reach $3.7 trillion in 2018, a 4.3% increase from last year. CDW is perfectly positioned to capture some of this demand because of their international reach to different markets. Some of CDW's product segments include hardware, software, and IT services. Each product segment is expected to grow in 2018. This will drive incremental sales and increase their market share. CDW has the resources and capabilities to conduct business overseas. The recent acquisition of Callaway allows CDW to better serve customers in the Eastern Hemisphere. In the UK, CDW houses a 120,000 square foot distribution center, which allows them to do business in over 100 countries. Even though their international segment only accounted for 10% of sales in 2017, we believe this segment offers the greatest organic growth opportunity for CDW. This investment has proven to be successful because it's currently growing by double digits. We are forecasting 11% of total sales coming from their international segment in 2018. CDW is doing an outstanding job managing their debt and set a target of 2.5 to 3 net leverage ratio. In 2017, their long-term debt to EBITDA was at 2.7 and has been decreasing steadily since 2014. Their interest rate expense does not put a strain on the company's financial health. In 2017, their EBITDA covered their interest rate expense almost 8 times over. CDW also took advantage of the low interest rate environment. 95% of their total debt is either hedged or at a fixed interest rate. We are not anticipating a high cash outflow in 2018. Their long-term debt obligation is at $25 million. CDW is financially sound and has enough assets to cover its short-term obligations. Its current ratio has been positive above 1 the last 4 years. 2018 is going to be a strong year for CDW.
In order to get a fair and accurate value